All right, take a minute and imagine yourself in this scenario. You saved $1 million and you've got $25,000 a year in Social Security coming in, and you'd like to get $50,000 off of your million to add to that for a total of $75,000 a year. That sounds great. Simple. I just need to earn 5% on my $1 million. Well, it's not really that simple. Take a second and think back 30 years ago. How much was a loaf of bread? Well, the answer is 75 cents. And a gallon of gas was just $1.25. So 30 years from now, you can anticipate that things are going to be a lot more expensive than they are today. So you're really going to need to earn more than that 5%. But what if you're not comfortable taking the risk to earn that? Well, you have a couple of choices. One, you could reduce your standard of living. Let's just say, for example, you have a house with a good amount of equity in it. You could sell that, buy a smaller home, go be mortgage free, and things would be great. You might be just fine. But you can also choose to take more risk. But what we want to do today is talk a little bit about how you could take more risk but still feel comfortable doing it. So let me tell you a little story about just today. I was literally reviewing some accounts for some clients, and I came across something that describes sequence of returns perfectly, because I want you to understand this concept of sequence of returns. Two different clients, they bought the exact same investment 3 months apart. One bought it 15 months ago, the other one bought it 12 months ago. One got a return of 24%, the other one got a return of 5.5%. Now you might think the person who bought it 15 months ago got the bigger return because they had a longer time for the investment to work for them. But the reality is the person that bought it 12 months got the higher return because of sequence of returns. Right off the bat, the value went down on the investment the person bought 15 months ago. And then right there at the bottom, that second gentleman bought it, and it was right at the perfect time, and it went right back up and beyond where it all started. So here we are, 15 months later, one person with a 5.5% return, the other person with a 24% return. Now we have a little chart for those of you who kind of see things more visually. You can look on the screen and see to help you understand the concept of how when you start off with a good return, you'll end up in a much better place than the person who starts off with a bad return. Second thing I want to talk to you about a little bit before we get into the meat and potatoes of all this is volatility. And the only thing I want to talk about volatility is volatility creates emotional stress. So you need to really think about maybe when you've been investing in the past. At what point did you give up or break? How much volatility were you willing to accept? Because if you move your portfolio around and you start creating lots of volatility in your portfolio, the fact that you allow that to make irrational or bad decisions could also really harm your overall returns. So, lastly, let's just take a second and think about the perfect investment. What does that look like? If you could design the perfect investment, what would it be? Things like absolutely no fee, unlimited returns, no risk at all. Obviously, that doesn't exist, but let's see if we can find some ways in our discussion here today to at least bring some of that into a reality and make it possible for you to feel more comfortable taking slightly more risk to give you that better return that you need. Now, let's take a minute and talk about 2000 to 2019, because this is the part of the stock market I chose, or the time period in the stock market I chose, to help illustrate the methods that I'm going to show you and how they worked. So between 2000 and 2019, we had the dot-com crash of 2000 to 2003. And then we had the financial crisis of 2008. These were two really bad periods in the market. And then the market after that recovered quite well. From 2009 to 2019, we had a really good recovery. So I think this makes a great time period to illustrate and show you how these strategies can work. Now, I'm going to put a chart up on the screen for you. And this is a history of the bond market during that time period. The one thing I want to point on here is 2022. you can see that the bond market went down 13%. Well, that's a pretty big move. And for people who are thinking, oh, I could just buy some bonds in our earlier conversation for 5% and I'll be just fine, I need you to understand that bonds can have risk with them as well. Interest rate risk, time risk. There's different risks that associate themselves with bonds that you don't have on the stock side. But on the next chart, what you'll see is a history of the stock market. And I've overlaid some of those returns from the bond market onto this chart so you can take a look and see in the years that the bond market did perform badly, how did the stock market do? And vice versa, in the years when the stock market did well, how did the bond market return? All right, let's dig into our two strategies now. Now remember, we're doing this from 2000 to 2019. All the numbers are for that time period. We're going to use the S&P 500 as our comparison to each of the strategies. So let's start out with a 60-40 mix. Now you could make this mix anything you want. 60% stocks, 40% bonds are the numbers I'm going to use. If you want to be more conservative, you could make it, 50-50 if you wanted to, or even more so. But for this illustration and for the numbers here, we're going to use a 60-40 mix of stocks and bonds. We're using the Bloomberg bond index for the bonds and the S&P 500 for the stocks. So we're not mixing and matching anything. We're keeping everything concise and the same in each category, time and investment. Now, we're going to start out with $100,000 in this investment. And we're going to find out that if we just bought the S&P 500 for that time period, our $100,000 would have turned into approximately $225,000. Not bad, but you took on, remember, I showed you the years on the S&P 500 chart. You took on some serious volatility to get there. Now, if we take and add 40% bonds to that, we're going to reduce the volatility. We're going to make the ride cleaner. And you can try and make a guess here. Do you think we ended up with more or less money at the end? Well, the answer is we ended up with a little bit more, $243,000 approximately. Adding those bonds to your portfolio can actually reduce your overall volatility and increase your returns. Look, this has been around forever. People have been using the 60-40 model or some percentage similar to that for as long as I can remember, long before I even got into the business. So this isn't any new information, and you may have seen this before. But this next idea I've got for you is called a buffered strategy. And the buffered strategy you may never have seen before. It's going to take me a minute to lay it out for you, but I think you're going to find it really interesting. So let's get started with that. Let's talk about what a buffer is and how important it is. Let's imagine we have two investors that both invested $100,000. And in the very first year, that investment goes down $10,000 for each of them, or 10%. And let's assume we have a 10% buffer. So at the end of the first year, investor number one has $90,000. Investor number two has their $100,000 still, because their buffer replaced the loss. So now we start year two, and let's say we have a 10% return in year two. Well, in year two, investor one makes it back $9,000. 10% of $90,000, $9,000. They're at $99,000 at the end of year two. Investor two got his $10,000 back and made 10% on his $100,000, so he's at $110,000. So what I'm pointing out here is the importance of a buffer is it mitigates loss. And mitigating loss can be just as important as the gains you're receiving. Now, over time, this is going to build and build. Every time you get a buffer, you get to start at a new higher level than the person that didn't have the buffer. And when we do modern portfolio theory or a 60-40 mix, isn't this exactly what we're trying to do? We're trying to mitigate loss so that we can start at a better point as we go forward when things are good. In the case of a buffer, this is contractual. The investment you've chosen has told you exactly what you're getting before you buy it. You know what that buffer is going to be. So there's three different ways I can think of off the top of my head that you could buy these buffers. One would be unit investment trusts. A second would be ETFs, or exchange traded funds. And third would be RILA contracts. That's a registered index-linked annuity contract. Now, there's pluses and minuses to all of these. With the ETFs and UITs, they tend to be relatively short in nature, usually 15 or 24 months. They'll give you maybe a 10, 20, or 30% buffer that you can pick from. And because the buffers are, the bigger buffer is bigger, you'll get less return of the market. So maybe they'll cap you off at, let's just say hypothetically, around 8%. On a 10% buffer, you might make as much as 15%. So if the market goes up 30, you're only going to make 15. So in this case, we're capping you out on what you can make, but we're also capping you out on what you can lose. On the RILA contracts, they're a little bit longer, so they're a little bit more generous on the upside. You could pick a 10 or a 20% buffer, and then in current contracts that I'm thinking of right now that are available at the time I'm filming this, they're offering a 110% participation rate. So you're actually getting a bonus, if you will, on top of the return of the market. So what does that look like? That's designed to happen every 3 years within the 6 years. So you go in year one, you put your $100,000 in. In year three, it's worth 90. Well, you get your money back. You have $100,000 to start off again for the next 3 years. If that had been a good 3 years, you would have gotten the participation rate. So if you were up in value on the contract, you would get 110% of that return as your participation rate. Now, what are the goods and the bads of these things? Because not everything is, all roses. On the ETFs and the exchange traded funds, on the ETFs and the UITs, you have fees. ETFs and UITs are typically very similar to most investments you'll find. You're going to find them between a 0.5 percentage point and about 1.25 percentage points. They're going to be reasonable fees for what they're offering you and the guarantees that they're giving you, or the buffers they're giving you. A downside would be they are capping your return, so you aren't necessarily going to make everything that the market makes. On the registered index-linked annuities, we have a very low fee structure, or almost actually no fee structure. On the base contracts, there's no fee at all. You can add things. You can add better death benefits and things like that, and they would charge a fee for that. But if you just want the simple buffer and the participation rate, there are no fees on these contracts. So you're getting a great benefit at a very low cost. The downside here is you are tied into it for 6 years. You can typically take 10% a year out without a penalty, but if you did choose to liquidate it, you would have a penalty when you liquidated it. All right, now that we know how the buffer strategy works, let's take that and apply it to our example from 2000 to 2019. So remember, we had a buffer happen in 2002 and 2008 during that time period. But what did that do for our overall results? Well, remember, the S&P 500 ended with a value of $225,000. Our $100,000 investment in the 60-40 mix ended with a value of $243,000. And our buffer strategy ended with a value of $325,000. So you can see that those buffers really did help. When we started this discussion, I asked you to think about the perfect investment. Well, put that back in your mind again, and now apply it to what we've come up with today. Look, we know it doesn't exist, but through this process, we haven't done no fees, but we've lowered our fees substantially. We haven't created a portfolio with no volatility, but we've lowered that volatility substantially. And a reasonable return. No, it's not unlimited, but it's a good, solid, reasonable return based on the markets. I would love to continue this conversation, and if you think that would be helpful, there's a calendar below where you can pick some times and dates to meet with us. It's complimentary, and you can do that through phone, Zoom, or in person. I'm going to leave the website in the description so you can reach out to us that way as well. And also, check out our other videos online. You might find them helpful. And finally, throw a note down there for videos you'd like to see in the future. Maybe your topic will be the next one we do. Thanks for watching.